What is up, friends? Hey, yesterday I ran a poll on social media where we asked, what's the number one reason why sellers are staying in their home today and not selling? Now, this may not come as a surprise to you, or it may come as a surprise to you. The number one response was the interest rate question we've been talking about for about a couple years now. And that is, most people do not want to give up that 2 to 3% interest rate that they were able to lock in back during the COVID market. Now, if you've been watching our videos for a while now, you've heard us talk about the interest rate is just a slice of the pie when it comes to your current monthly mortgage. What I mean by that is there are a lot of other multiple factors that go into affecting what that payment is. Matter of fact, check out our YouTube video on why is our mortgage payment so high. We actually talk about the fact that prices are up, insurance is up, the cost of material is up, so things like insurance are impacted by that. And overall, your payment is affected by all these different categories. Now, I say that because oftentimes if we get stuck focusing on one slice of the pie, we may miss the overall bigger picture. Even if rates were to fall, which I'll touch more on that in a second, that doesn't necessarily mean the mortgage payment is going to move to a comfortable number compared to what we're currently dealing with. Not only are you locked into that 2 to 3% interest rate from a couple years ago, that payment is based on the price that you bought in that market as well. Now, prices are up since then. Matter of fact, they're continuing to swing up. And even if rates were to drop, say, 0.5%, go from 6% to 5.5%, your monthly payment may only move a couple of $100s. Now, interest rates today are actually lower than where they've been since 2022. So we're in a really good spot with rates hovering around that 6% mark, and a lot of our buyers are coming in under 6, whether they're buying points or getting seller credits. That's a conversation for another day. And yet, how many of you have a car payment or a credit card payment that's above a couple $100s a month? Now, the way our sellers are winning today is by taking that equity that they have in their house. They're giving up that 2 to 3% interest rate. They're like, you know what? We need to get a different house for our lifestyle needs, whether it's bigger, smaller, all one floor living, different area, closer to work, closer to jobs, closer to family, etc. They're selling their current house, taking that equity and getting rid of some of that bad debt. Now, we're going to illustrate this more in a second. According to Investopedia, and there's other studies out there too. Matter of fact, do a quick Google search and just type in, how much equity does the average homeowner have? You may be surprised to see the answer. According to Investopedia and some of these studies done, the average homeowner has over $300,000 in equity. Now, even if your equity is not that high, 2/3 of all homeowners in the United States have over 50% equity. What that means is their loan balance on their house is 50% what it's worth or less. Now, that is cash in your pocket if you go to sell your house. What some sellers are making the mistake of doing is they're taking all of that equity and throwing it at the new house. They're trying to get that mortgage payment as low as possible. And then when it's still a little bit higher than what they were expecting or what they wanted based on where they're currently at, they're blaming interest rates. Well, here's the catch. Suppose you took some of that equity and you put it into the new house. We have all heard the old adage of you have to put 20% down. The reason why people want to put 20% down on a house is because it eliminates PMI, or private mortgage insurance. So it does make your monthly payment a little bit less. So if we assume we're putting 20% down on a house, we should have some money left over based on our equity. And matter of fact, if you do, you should save that money, and here's what we're going to do with it. If you have a car loan, let's wipe that out. Let's pay off the debt, pay off the credit cards, pay off the student loans, or at least get it to a more manageable number. Now, not only is your overall out-of-pocket monthly expenses going down because you no longer have that car payment or those credit card payments, those categories fall in debt. Your mortgage payment can actually be a little bit higher because you're buying a higher priced asset. Your home will go up in value over time. So even if your monthly payment towards your asset is a little bit more, that's okay because you're building equity up again because your asset value is going up. Your debt, your credit cards, your car loans, your student loans, that value is not going up unless you pay that amount down or that balance down. It's still not an asset. So yes, your monthly mortgage payment may be higher, but that's okay because we bought a more valuable asset. By the way, if you lock in today's prices at today's interest rate, you're in a better spot moving forward because your payment or your assets locked in for that loan balance And as that asset value increases over time, you're building equity that much faster. Now, real estate is a simple supply and demand problem. You've probably heard or seen our videos where we talk about this in the past. As interest rates fall, the cost of borrowing money goes down, meaning it's more affordable to get a loan, which means more people are going to want a loan. And so if that happens, demand is going to go up. And without a corresponding increase in supply, that means demand is going to go up, supply is going to stay the same, or eventually go down, which means prices are going to go up. So you're going to be sitting there waiting for interest rates to fall. In other words, you're waiting for demand to go up. So what you're going to buy is going to become more expensive. You're waiting for what we think is going to be savings, and in the long run ends up costing us more money. If you've already locked in at that price, you buy today at today's price and today's interest rate. If rates fall later, you have the opportunity to refinance. Yes, refinance comes with costs. You do have to pay closing costs to do it. However, if your asset, your home value has gone up, you have the ability to roll some of those refinance costs back into the new mortgage. So you may be able to, in a stance where you can refinance for free or close to it. And then you're locking in at that future rate and you're no longer in competition because you already own your asset. So what should you do? In essence, you shouldn't wait. Matter of fact, we're seeing a spring market here in Richmond, Virginia, and it's earlier than typical. Homes are moving quickly again, and that's good news for sellers because we just talked about all that equity they have. So what you should do is we should chat. It's a no obligation conversation. Let's just have a chat about how much equity you have in your home and what you could do with it. Matter of fact, some of our clients are even selling their house and they're having leftover equity after putting the down payment down that they want to put. They're paying off a car or two. Maybe they don't have student loans or they don't have credit card debt. So they have some money left over, or they pay off everything and they still have money left over because they were in a really good spot. Well, then we can actually pair you with one of our preferred financial advisors and invest that extra equity, and you can get a return on your investment. So now you have a more valuable asset, you have less debt, you're in a better financial situation overall, and oh, by the way, you have some investments coming to play too. That is how you win in this market. That is how you win regardless of what interest rates are, and we want to help. We want to be your resource of choice. So reach out directly. Shoot me an email at info@edenpropertiesva.com or text me directly. My number is 804-840-3260. Again, that's 804-840-3260. Looking forward to helping you win in any market. Chat soon.